Imagine waking up, opening the platform, and seeing everything moving as if the world had entered a turbo mode of uncertainty. The US index is plunging, currencies are stretched, and Europe melting right at the open. Most people look at that and think, today's not the day. But a prepared international trader thinks differently. Today, the market is full of opportunities. I just need to know how to position myself. And if global volatility has been making you more nervous than strategic, stay with me. Because today, we're going to talk about how to navigate this scenario intelligently. Guys, I am Chad from Zero Markets. And today, I want to talk to you about volatility and the trader. When we talk about global volatility, the image that comes to most people's mind is that nervous chart going up and down nonstop. But the rabbit hole goes much deeper. Volatility reflects several factors hitting at the same time. Interest rates decision abroad, inflation data that shifts expectations, geopolitical tensions, earnings from global giants, growth revisions, all happening in layers. International traders feel the pressure of these variables directly. And then comes the question that always bothers a little bit, but it's got to be asked. Are you trying to guess where the market is going, or are you building a conscious plan to take advantage of and survive what it delivers to you? The first thing to understand is that volatility isn't the enemy, guys. It simply shows that prices are moving more in less time. This creates potential, yes, but it also amplifies risk. Amateurs look at these days and think about increasing their lot size. Experienced international traders think about adjusting risk before looking for opportunity. On days with heavy data releases, such as payroll or rate decisions, professionals reduce exposure, they limit their position size, and they act with mathematical calm. They don't try to hug the whole market. They try to protect themselves before anything else. And then comes another essential point. Global positioning requires reading beyond the obvious. Being an international trader is not simply trading out there, but understanding correlations. There are days when the US index is completely irrational, but Europe offers cleaner moves, or the opposite. Sometimes clarity is in commodities, sometimes in currencies, sometimes in the most popular asset. Smart traders watch the whole world with the same logic. Which market is delivering movement that makes sense within the global scenario? There's also a huge difference between working with predictions and working with scenarios. The trader who lasts does not try to guess the future. He builds possibilities. Before an important event, he thinks about the optimistic scenario, the neutral one, and the pessimistic one. And with that, he already decides in which context he operates, in which he reduces size, and in which he simply stays out. Staying out for him is an active decision. It's as strategic as hitting the buy button. On the most volatile days, smart positioning means trading less and trading better. No chasing trades all day, no desperation hunting for random moves. You wait for the market's most efficient moments, truly important zones on the chart, and let the context show you that the trade makes sense. And of course, you maintain risk management that is almost surgical. Stops respected, size controlled, no impulse to double positions just to recover. And here's something almost no one talks about that makes all the difference. Emotional control. International traders deal with news from several countries, different time zones, events happening practically every day. Without clear limits, the mind never rests. I'm going to repeat that. Without clear limits, the mind never rests. Having a time to stop, review the day, understand what was rational and what was emotional, that protects you more than any indicator. And the phrase that frees the most mental energy is, you're not your daily result. You are not your P&L. If this video is making sense to you, or at least making you 1% more critical about the market, then hit like so YouTube knows that you want more videos like this, and subscribe to the Zero Markets channel to always receive smart and direct content without any of the fluff. When the whole world enters turbulence mode, the international trader who tries to control everything by force ends up getting hurt. The one who understands the game positions himself firmly. He treats volatility as context. He adjusts position size. He thinks in possible scenarios. He diversifies global exposure. He controls emotions and acts only when the market shows clarity. Volatility stops being a threat and becomes an environment of opportunity, as long as you enter it with process, not impulse.